Hi guys, Milad Reza here. In today's video, we are going to go through a superannuation cheat sheet. What I've organized for you guys is 6 critical points to consider and be all over when it comes to superannuation. And when I sit down with Australians, I always tell them, here's what you know about superannuation and here's what you're missing. And this is the missing portion. So it is critical to understand all these points that I'm going to bring up for you guys. So stick it out with us for the next few minutes, because if superannuation is going to form any part of your retirement, it is absolutely vital to watch this video. So today's video is general in nature, and none of this is financial advice in any way, shape, or form, and for educational purposes only. And we're not taking into consideration your financial circumstances. So if you want to go ahead with some financial advice on the back of any of this, or if you want to make any changes, get the right professional by your side to do this. So number one in the cheat sheet points that we're going to put out there for you today is your super fund, in terms of its investments, is it income focused or is it growth focused? We've been talking about income versus growth, are completely different things. Income is considering what is coming through in terms of when it comes to share investing, which most Australians have inside their super fund by default. That is the that is the dividend income that is coming through. So from your investments, in terms of shares, you have what we call dividend payouts or income distributions, and they are paid to your super fund. And it's quite vital to understand that. In terms of REITs, which is the property side of your super, again, everyone has property inside their super. REITs is real estate investment trusts. It is a listed property asset class, and by default, again, most Australians have it. And that would be, for the income side, would be the rental income that comes through. Now, when you are looking at the growth side of it, the growth is just that share price going up, or the capital capital gain on the prices of those properties. What your super is focusing on, what it's investing in, and what those fund managers are focused on, whether it's income growth, can make a really big difference in the long run. So when we look at income, it's more to do with what the profits of those companies are, basically. Say, for the sake of some Australian companies that you may be invested in, big cap companies, the 4 big banks, or whether it's the mining sector with BHP, it's those distributions from their profits that the super member is receiving from those share investments. The share price increase is the growth side. So it's just so important to understand the differences there and understanding what your super is focusing on. It makes a world of difference long term. Number 2 is tax offsets. Tax offsets. Not many people talk about this space when they are thinking about, how can I grow my super fund? Superannuation tax in Australia is 15%. So if you think about the average Australian would be paying thousands of dollars of tax inside the super fund. The first point of taxation is money hitting your super in terms of pre-tax contributions, and that's just make it simple, employer contributions. So only 85% enters your super fund. The first 15% is taxed. And in terms of your returns, again, there's a taxation of 15% with your returns. A tax-friendly environment, but there is a 15% tax that you need to pay. And you are entitled to tax offsets inside your super fund when you have Australian shares inside your super. Now, some Australian shares, I might add. And how your super treats these tax offsets is vital, because the two main structures in Australia in terms of superannuation treat them very differently, the way they are processed. And most Australians sit in a master trust structure that has all of these tax offsets bundled into the unit price and cannot be tracked. You cannot actually see what is coming through, and it may cause some entitlement delusion or transparency issues. Third point to the cheat sheet reveal today is, does your super have unlisted property investment options? Now, what comes in most super funds is the listed stuff. So basically, what is on the ASX in terms of buying shares in companies that go out there and invest in commercial real estate. Unlisted is a completely different story. Unlisted is valued once a year when you are investing in unlisted property. So it's not exposed to the volatility of the share market, a completely different way that it's ran. And on top of it, it comes with really effective deferred tax component with a lot of these unlisted property asset classes that you can find in certain superannuations. So uncovering that is very, very important as well. Now, the fourth factor when it comes to the cheat sheet reveal is how is your super fund actually invested? Is it focusing on active fund managers or passive fund managers? These are the two main fund managers inside of your super fund, and they completely operate in a different manner. So active, you do pay a little bit more for active, but it comes with two very important aspects as well. If the markets are going down, you'll find many active fund managers have built-in strategies to soften the blow. And on top of that, if you want to get a potential alpha, which is getting a return above the market, is what comes with the active management. Now that has potential, so it's not guaranteed, but it is what's out there. And it does cost a bit more to have active fund managers inside your super fund, but those are two areas that you need to consider. The point in the cheat sheet revealed today is, does your super fund have cash flow controllabilities? Now, what we're referring to there is having the capability for you to build up a certain amount of cash inside your super fund. And what that would potentially enable you to do is not have to sell units cheap, because what happens in a market downturn, your unit prices go down. And if you're taking money out of your super, what you are doing is you're effectively selling off the farm, because you are selling these units very cheap to take out the same amount of money for those drawdowns that you would have had to say the prior year when the market was doing well. Now, to explain that a bit further, imagine each unit is worth $1,000 and you have 10 units. So you have $10,000 of super in store. Now, if you wanted to take out, say, $1,000 from your super fund, you would only sell one unit. Now, if those unit prices drop to $500, take out the same $1,000, you have to take two units out. You have to sell, two units. So you're basically selling off the farm just to take out the same amount of money. If your super fund has the capability to store cash and has the structure for you to have a cash account in there, what you can do is have a bit of a buffer potentially in place, so that even when the markets are down, you're not taking to take money out of your super, you're taking it out of an environment that is invested in cash. And that means that you don't have to sell any of the investments in the background potentially, or you can sell a lot less, which then what that does is it to a certain point removes sequential risk, and that is having to sell when the market is down. So very vital point to consider there. It makes a world of difference. What you see is most Australians super funds doesn't have that capability, and that's why you see retirees come back to work, because they've sold off the farm when the market's gone down. And if you're thinking, what does he mean by the market's gone down? I mean, the next inevitable bad event. Bad events have happened, will always happen, and it's just about having the right strategies in place so that we are making the best outcome for our super fund. The last point that we're going to talk about in the superannuation cheat sheet reveal is management expense ratio. Management expense ratio inside your super is one of the biggest costs of your super, and that is what you're paying your fund manager to invest your super. Your super fund is invested. You got to pay someone to invest it. No one's going to do it for free. And in every super fund out there is a management expense ratio. It can range from very low to very high. So you need to understand this. A super fund can have a management expense ratio of, say, 0.004, or it can have a management expense ratio of 0.015. And the difference there is huge. So for that extra portion, you need to justify and understand whether it's actually worth the cost for paying that management expense ratio. And certain super funds for the same investment exposure charge you a lot more. So again, you need to dig deeper, understand that. Now, if your super balance is a bit lower, it's not going to make a world of difference. If it's anything under probably like $10,000-$20,000, it's not going to make a really big difference. But as your super grows, management expense ratio is just going to magnify it more and more. So they're the 6 points that I wanted to go through with everyone today, and they will make a really big difference to your super fund. Now, it was a high-level conversation today. If you want to find out more about each of these points and want to relate it back to your circumstances, there's a link at the bottom. You can lock in a free 30-minute video strategy session one-on-one with an advisor, and we will go through all those areas for you and more.